On March 8, 2022, traders bought and sold billions of dollars worth of nickel contracts on one of the world's oldest commodity exchanges. Hours later, the exchange announced that those trades no longer existed. Not because of a software failure, not because orders had been entered incorrectly, but because allowing them to stand could have pushed multiple financial institutions into default. In a decision unprecedented in modern financial history, the London Metal Exchange didn't just halt the market, it wound back the clock, declared 8 hours of executed transactions null and void, and wiped nearly $12 billion in trades off the books. To buyers who watched billions in paper profits vanish, it was an institutional betrayal. To the exchange, it was the only way to prevent a systematic collapse. Today, we use newly uncovered regulatory data to look inside the plumbing of the clearinghouse, trace the invisible mechanics of a default cascade, and examine how the ultimate crisis management tool might have altered the rules of the free market. The roots of the crisis trace back to a massive structural asymmetry in how industrial commodities are hedged. The Chinese industrial giant Tsingshan Holding Group, the world's largest nickel producer, held a massive short position. Estimates range from 100 to 300,000 tons. In theory, this was a hedge to protect their physical inventory against falling prices. But the exchange couldn't see the true scale of the risk. A significant portion of Tsingshan's short position was held off exchange, built through private over-the-counter agreements with commercial banks. Because these OTC positions were fragmented across multiple banks, neither the LME nor individual clearing members had a complete view of Tsingshan's total exposure. Yet, the LME public exchange price remains a benchmark reference value for all those private contracts. In late February 2022, Russia's invasion of Ukraine triggered intense fears that supplies of high-grade nickel could be disrupted. The exchange price began to move upward, and the hidden leverage turned into an inescapable trap. To maintain a short position when prices rise, a trader must post cash to cover mounting paper losses. As the price escalated, Tsingshan faced a severe liquidity crisis and struggled to meet the scale of its margin obligations. To limit further exposure, short sellers were forced to buy back contracts, creating a self-reinforcing short squeeze. By March 8th, the market had decoupled from fundamental demand entirely, forcing the exchange clearinghouse into a mathematical dead end. To understand why the system was on the verge of breaking, we have to look at the invisible infrastructure of financial markets, the central counterparty, or CCP. When you trade on an exchange, you don't face your original counterparty. Through a legal process called novation, the clearinghouse, in this example LME Clear, steps into the middle, becoming the buyer to every seller and the seller to every buyer. Before CCPs, a default by one major trader would trigger a domino effect of unpayable debts across dozens of individual banks. The clearinghouse fixes this by netting all identical contracts down to a single obligations pool, completely eliminating bilateral counterparty risk. In a functioning market, it turns systematic chaos into orderly, centralized mass. To survive extreme price swings, the CCP requires clearing members to post two types of collateral. Variation margin pays today's loss. Initial margin acts as a collateral against tomorrow's potential loss. A margin breach occurs when the current market loss exceeds the initial margin already sitting at the clearinghouse. A working paper published by the Office of Financial Research provides the precise data on how heavily this squeeze would have overwhelmed the system. According to the OFR data, LME Clear experienced margin breaches of historic magnitude. The largest single account breach reached nearly $2 billion. To understand how staggering that is, look at the exchange's defenses. The entire pre-funded default fund, the emergency pool paid into by all 45 clearing members to absorb a default, was only $1.1 billion. A single account had experienced a loss nearly twice the size of the entire collective firewall. The OFR paper notes that LME Clear's maximum margin breach hit 182% of its default fund. For context, other global commodity or financial clearing houses historically rarely cross the 50% mark, even during severe macroeconomic shocks. The market move had completely overwhelmed the resources calibrated by the existing framework. The decision to cancel trades was widely criticized as an intervention to protect a single, well-connected industrial player. However, during subsequent legal proceedings, the exchange disclosed internal simulations detailing what would have occurred if the market had been allowed to open normally on March 8th. It is vital to separate the numbers here. The exchange estimated that continuing as normal could have triggered another $19.75 billion in total intraday margin calls across the market. Cash demands several members might have not survived. If those margin calls went unpaid, the immediate deferred losses handed to the clearinghouse would have hit $2.6 billion. The simulation shows how this would have triggered a systematic cascade. In round 1, 7 out of LME's 45 clearing members would have immediately entered default. Absorbing their $2.6 billion loss would have completely vaporized the $1.1 billion default fund, leaving $220 million entirely unrecovered. To bridge the gap, the clearinghouse would have been forced to trigger its standard loss allocation rules, legally requiring the surviving clearing members to write additional resources and replenish the default fund by an estimated $1.17 billion. This brings us to round 2, forcing a $1 billion liquidity call onto banks in the middle of a historic market panic would have broken the remaining defenses of 5 more clearing members. In total, 12 clearing members could have entered default at LME Clear, more than a quarter of the exchange's entire membership. LME Clear could have exhausted its pre-funded resources, forcing emergency loss allocation and potentially spreading distress across the wider clearing market. The board wasn't choosing between right and wrong. They were choosing between breaking the market rules or watching the clearing system fail. Quantitative funds, including Elliott Management and Jane Street, filed suit against the exchange for nearly $500 million, arguing that erasing executed trades to shield failing participants compromised the core principle of market integrity. In late 2023, the UK High Court upheld the LME's authority to cancel the trades, although its reasoning differed depending on whether the transaction had already entered the clearing process. The court concluded that when participants join the exchange, they explicitly bind themselves to the rulebook, specifically Trading Rule 22.1, which grants the exchange broad discretion to intervene during periods of market disorder. Legally, the decision confirmed the exchange's powers, but economically, it leaves an unresolved precedent regarding moral hazard. The fundamental value proposition of a clearinghouse is trade finality. If participants know that an exchange can cancel trades whenever fulfilling them threatens the clearing system, then the meaning of finality changes. Furthermore, standard clearing design dictates that a CCP must risk its own equity first during a default, so to say, its skin in the game, to ensure it has a strong financial incentive to manage risk. By canceling the trades entirely, LME Clear never had to touch its own capital. As the OFR paper points out, if an exchange can deploy trade cancellation as an emergency escape hatch, their incentive to monitor concentrated risks and opaque OTC leverage may become weaker in the future. The London Metal Exchange avoided a severe default cascade, but the long-term cost to its reputation remains high. Banks' internal assessment of LME Clear deteriorated sharply after the crisis, with risk ratings dropping by 2 to 3 notches. Trading volumes in the nickel market contracted significantly as key liquidity providers chose to reduce their exposure or walk away from the venue entirely. The 2022 nickel squeeze exposed a fundamental limit within modern market architecture. Central clearing is designed to mutualize losses, demand collateral, and absorb defaults, but it cannot create liquidity where none exists. And when the cash demands become larger than the system can bear, the final line of defense may no longer be the default waterfall, it may be the rulebook. The London Metal Exchange saved the market by declaring that 8 hours of the market had never existed, but paid a high price doing so. Thank you for watching. If you enjoyed the video, feel free to like, subscribe, and comment your thoughts. Have a nice day.